Unemployment rises, sending bond yields sharply lower, pleasing J-Power and the stock market. I run you through all the jobs data, my reaction to Apple's earnings, a look at US debt, China on the rebound, and what happened to my video yesterday. And welcome back everybody to the Click Capital Daily Market Review on this Jobs Report Friday, in which we've got a lot of big moves coming out across key markets I'm going to get into today and show you everything that's happening out there. But first, just a little bit about what happened to my video yesterday, as it didn't show up on this platform. So normally what happens is you upload the video, it finishes uploading, then it goes through some automated checks and could be potentially sent to human reviewers if there's something controversial in the video. And normally that takes 5 to 10 minutes. However, yesterday that was still stuck after 4 hours, and I tried re-uploading, still to no avail. So I went ahead and uploaded it to X, formerly Twitter, on the Click Capital channel, in which it uploaded just fine in under a couple of minutes, and where you can watch it today if you're interested in seeing that video. And so if you are on X Twitter, then just search for Click Capital or click the link below this video, and make sure you follow me on X, and you'll also see a little bell icon, and if you click on that, that'll notify you every time I publish my daily market review. You'll get a push notification to your phone, and my daily videos will always be uploaded on X first, as it only takes a couple of minutes for them to be published onto here, and so that's what I'll be doing going forward. Also, as a reminder, you can watch my daily market review on my website clickcapital.io. Just click on daily review and it'll always be on there around 5 hours after market close in New York, and so you'll always be able to find my daily reviews on my website, as I have total control over what gets published on my website, obviously. And so if you'd like to help support this channel and my efforts, then please click that like button or love button, whatever platform you're on, to let the algo know that you appreciate this content and want to keep on seeing it. Okay, so let's dive right into the daily market review. Quite the bullish day to finish this week out. You can see that in the market color. Green across the board, everywhere where the bulls want to see it. And red in all the areas they want to see as well. Volatility, bond yields, oil, gold, energy, the dollar, and inflation expectations, all downtrending up the front. And so we've had quite the flip here in the market today, taking out multi-week highs on the S&P 500, closing above 51.20 in this resistance zone that I'd say is very likely to get breached next week on the upside. And part of my reason for thinking that is the absolute VIX crush we got here today, taking out support around 14.5, where I previously thought we may find a bit of a floor. However, option dealers are pricing in more good times ahead, and we can especially see that in the volatility risk premium, VRP. That's the premium of the VIX index over realized volatility. You could think of it as what option dealers are demanding in premium to write option contracts over top of actual volatility in the market, and that's pretty much at break even now and been absolutely crushed the last couple of weeks. And the last time that happened was in late October going into early November. We got a big crush in VRP, and just switching over to the S&P 500 in that same period of time, late October going into early November, that was the start of a huge 5-month rally, which I'm not saying we're definitely going to get again. However, it does give the bulls a big tailwind here, as the option market is pretty efficient at pricing volatility and risk. And that is likely on the back of J-Powell's, once again, dovish pivot, pseudo rate cut, boosting liquidity, loosening financial monetary conditions, which in tandem with the Treasury sole objective is to get bond yields down, and which it looks like they have been really successful. You can see that in the 2-year today, having a big spike down to 470. Just a couple of sessions ago, we were above 5%. Same with 10-year, now hovering around 4.5. And like I'd been saying, it looks like the bond market could be trying to put in a bottom here. We've got some divergences showing up, creeping back towards the 50-day, and I'd say the risk is to the upside for bonds, with even the risky end of town, high-yielding bonds already well and truly back above the 50-day VWAP. And in another sign that animal spirits are coming back to the market, along with liquidity and loosening conditions, is the pop-up in Bitcoin here today, finishing over 6% higher and looking to reclaim its lost ground over the past few months. And in yet another sign the liquidity is flowing is the OG meme stock, GameStop, ripping up almost 30% today, because why not? And this is a stock I've had on my short list for quite some time, so I'll be eyeing this off for a potential short next week, maybe up around the $18 handle. I may have a stab at it. We'll just have to wait and see. Also finishing above the 50-day VWAP is the Nasdaq Qs, up 2%, more than the S&P's 1.2%, currently sitting at the 50, and the Russell 2000 now popping back above its 50, along with the composite chart of the Mag 7. Also helping out the bullish picture today was oil pulling back, as concerns in the Middle East are fading and supply is flush in the States. And we can see that looking at the daily of crude pushing towards the bottom of the support zone I've had in. That too looks likely to fall through next week as we approach the mid-70s per barrel in crude oil, along with drops in gas futures as well. So it's kind of a funny market and world that we live in, isn't it? The unemployment ticking up higher than expected, meaning not as many people are employed, a lot of people facing hardship, and then the stock market rallies in response to that. And that's pretty much because Jay Powell told us directly yesterday an increase in unemployment would be needed for a rate cut. And he did say it would have to rise by more than 0.2 percentage point to shift the central bank's focus away from inflation. So you could pretty much read that. If we got a 4.1 or 4.2% unemployment rate, Jay will probably go ahead and cut. And since economists were predicting the US economy created 242,000 new jobs in April, and it actually came in at 175,000, and unemployment at 3.9, above the 3.8 expected, that materially boosted the chances that we will get a late summer rate cut, as we can see in Fed Fund futures, really firming here that we're going to get the cut in September, even given about a 1 in 5 chance that we could have 2 cuts by then. And what's really different today is the market's now back to pricing in 2 cuts for the year, saying we're going to get a cut in September and another cut in December, which you could translate as Fed Fund futures forecasting that unemployment is going to materially rise above 4% and meet Jay's prerequisite of higher unemployment for him to cut. So let's just take a step back from the headlines for a minute and have a look at the data, which is what I always try and convey to you guys each day, is just show the data and put it into context. And even though I try and keep it as factual as possible, you never know whose feelings you're going to offend these days. However, I'm going to keep doing what I do and just present the data and let you be the judge of it. So here we're looking at job growth, which did obviously come in lower than expected today. However, just keep in mind that's just 1 month. There can be a little bit of noise in the short term. That's why it's always best to smooth out the data with a moving average, which we can see here in the dotted black line is a 3-month average of monthly job growth, which is still coming in at 242,000 and is actually still above pre-pandemic levels. So even though the headlines make out the jobs market's really contracting, we're on the verge of a recession, this data suggests otherwise. And we did get those big bounce backs in 2022 after all the job losses in 2020 and COVID. Also, the unemployment rate at 3.9% is still well below the 75-year average of 5.7%. So this jobs market is nowhere near a dire situation. Not saying it can't go into that situation. However, right now, it's still near record lows. And just looking at data for people in their prime working years, that's between the age of 25 and 54, the participation rate, in other words, out of all available people in this age bracket that can work, how many of them are working? Well, that's actually at 83.5%. And there's only been a few years when it's just been a tick or two higher than that. And again, pre-pandemic, it was actually lower, 81, 82. So apparently the big stagflation scare is over. There's nothing to worry about here. We're all good. Jay Powell and co. keeping the party alive and the liquidity tap on. However, the reality is, we still have persistent inflation. And if you're like me and got a bit of an aversion to seed oils, well, then I've got bad news for you. Price of olive oil has been skyrocketing these last few months, which means we'll be paying more for our favorite cooking oil for some time yet. On the other hand, chocolate lovers can rejoice. We're getting a sharp pullback, and the most favorite long trader trend followers this year, that is cocoa. Hitting trailing stops left, right, and center, and we can see that on the daily. After a crazy rip up, it has come off pretty hard here. Only a few weeks ago, we were looking at $12,000 a ton. Here we are today, actually getting a bit below $7,000 a ton. However, what is starting to wake up a bit is the important agricultural commodity of wheat, putting in another solid day, up 3% on volume. And so even though cocoa's pullback has helped the overall agricultural commodity space, we'll be looking to see if it can find some support and potentially consolidate, as this is likely to keep our food prices higher for some time yet as well. And so we just had some weak earnings from McDonald's and Starbucks. As I'm sure you all know, the cost of eating out's gone up a lot this last 6-12 months. People are pulling back on buying $7 coffees. And so even though the liquidity is flowing in financial markets, thanks to some clever engineering coming from the top, companies like Starbucks and other retailers could be in for some headwinds yet, thanks to higher cost inputs, staff wages, and if the job market really does materially weaken over the coming months, then these discretionary items are normally the first to get hit the hardest. And we were looking for some leadership from the market's second biggest stock, Apple. And even though this is a company with declining sales, a lot of key risks, stock market loved it. Thanks again to financial engineering. $110 billion buyback, which is solely done just to goose the stock price higher. And 60% of the time, it works every time, just like we saw with Apple today, finishing up 5.98%. Also helping out the rest of mega cap tech here today as well. Microsoft up 2.2%. NVDA popping back up above their 50-day VWAP, taking out my short stop. Amazon close to highs. Alphabet holding in there. Meta looking to climb back up. That was a really good dip buy on the open after earnings. And Tesla, similar pattern to Alphabet, Google, just kind of pulling back a bit from its gap up, but appears to be holding in there. But like I said, not doing so well, all pain no gain, is Starbucks, trading really heavy after the second consecutive quarterly miss. And so this meme pretty much sums up Apple pretty well. Some saying their latest product Vision Pro is already dead, their most important product iPhone sales falling over 10%, but the bulls ignoring all of that and just focused on the buyback, helping to prop the stock up, because at the end of the day, that's all that really matters to shareholders. And just moving on to a bit of macro analysis, we actually just recently heard from the Congressional Budget Office, who are normally a non-partisan and impartial umpire of US fiscal policy, released its latest long-term projections, revealing something that most of us already know, and that US finances are on a wholly unsustainable track. And that's something that's really accelerated since the financial crisis in 2008 and 9. Consecutive governments just spent record amounts while trying to lower tax, and then COVID just accelerated that with stimulus payments. And the projections are that US public debt as a percentage of GDP are going to blow out above 160% come the year 2050, and the government's already spending over $1 trillion of their $4.4 trillion in annual takings just on the interest repayments on that debt, and that too has exploded. In fact, it's just doubled in the last 4 years alone. And so the long-term risk is that the US bond market could have a meltdown, and we see an absence of big buyers, and two things could happen. Yields could get out of control. However, I don't think the powers that be will allow that. Instead, it could be a situation like Japan, where the currency gets decimated as the government try and inflate away their debt. However, the biggest buyers of US treasuries, who are offshore foreign entities, central banks, sovereign wealth funds and the like, the big elephants in the markets, they've already been pulling away from buying US treasuries for years now. Back before the financial crisis, over half of all US treasuries were bought up by foreigners. Latest count, that's dropped to 1/3 and is likely to keep going lower and lower. And so you may be wondering, with the US dollar being the world's reserve currency, given it the biggest advantage to print money, why doesn't the Federal Reserve, in partnership with the Treasury, just print away all this debt in a staged process, even if it took a decade or two? Well, I'll let Jared Bernstein, the chair of Council of Economic Advisors to President Biden, answer that for you right now.
The US government can't go bankrupt because we can print our own money.
It obviously begs the question, why exactly are we borrowing in a currency that we print ourselves? I'm waiting for someone to stand up and say, why do we borrow our own currency in the first place?
Like you said, they print the dollar, so why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Since they sell bonds and people buy the bonds and lend them the money. Yeah, so a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to, I guess I can't really talk, I don't get it. I don't know what they're talking about, like, because it's like, the government clearly prints money, it does it all the time, and it clearly borrows, otherwise we wouldn't be having this debt and deficit conversation, so I don't think there's anything confusing there.
So unfortunately, he sounds a little confused on that, couldn't really give a straight answer, and this is coming from someone who's supposed to be a leader in this space and helps to shape policy that ends up affecting millions of people's lives. And just moving on to the biggest stealth bull market this year, Chinese stocks, leading international stock markets higher year to date, putting in a big bounce and may have put in a bottom we may never see again in our lifetimes. Foreign investors slowly coming back to the market. Nothing changes people's minds like price action, and it could be the tide is turning on the previous narrative that China's uninvestable, as they've been working for months now to put a floor in their market. A lot of reforms, regulatory actions, on top of actual growth, like we can see with Hong Kong's latest blowout quarter, showing the spread between actual and median estimates, getting back to levels we haven't seen in over a decade since 2011. And there's a look at the most liquid Chinese ETF from the market, FXI, still really small at 4.64 billion assets under management. And technically speaking, today we've just gone back to trend mode on my trend strength indicator, and just looking at a weekly chart, ever since Xi Jinping visited US late last year, it was obvious to me that he was coming back to the table, wanting to do business, speaking directly to American CEOs, inviting them to invest again, and he's about to do the same in Europe soon. Going for a trip over there for the first time in 5 years to improve relations, attract foreign capital and investment back in their market, as Chinese stocks have been diverging a lot with world stocks this last couple of years. They've been in a 3-year bear market. However, like I said last week, I think that's changing. We're breaking out here, and this could be just the beginning of more to come, as we're almost up 20% year to date. Along with a big rip in Chinese stocks I'm invested in, Alibaba pushing up on high volume, multi-month breakout. Just last year alone, they bought back 8% of all outstanding stock, and they just increased their buyback program by another 25 billion. And the stock I shared with you guys last week as well, Tiger Brokers, having a really good update there yesterday. Little pullback here today, sitting above the 50-day VWAP. And Japan, up until about a month or two ago, had been the best performing stock market this year. However, here's the spread between China and Japan, which had been beaten down quite a lot this past year, is bouncing back as well. Even though the Bank of Japan have managed to stabilize their currency, they've intervened, and we've had a sharp pullback in dollar yen. Staying on currencies, got that bounce back in Bitcoin. A lot of people saying the correction's over and that we're going to grind higher towards $70,000 a coin following the dovish Fed meeting, keeping the liquidity tap flowing. Good for meme stocks and meme currencies. However, if you are into Bitcoin, just remember not to send your Bitcoins to the wrong address, because unlike your local bank that offers you protections in the case of a mistaken account number, that's not the case in cryptocurrency. Like we just saw, some poor soul lost 68 million by accidentally copying and pasting the wrong address and pressing send. And this weekend, we'll get to hear from the granddaddy of stock investing, Warren Buffett, hosting his first Berkshire Hathaway annual meeting without his long-time number 2 man, Charlie Munger. Be interesting to see what Warren comes out and has to say about everything. I always tune in and listen to that every year, and he's the biggest straight shooter of them all, and pretty much always says it how it is and is not afraid to criticize others. There's a look at the economic data prints we got today. Likely also helping the picture was average hourly earnings coming in lower than expected. There's non-farm payrolls materially lower than expected. But like I said, the 3-month average still above pre-pandemic levels. PMIs coming in better than expected. And then just looking out to next week, we've got a few Fed speakers to start off. Not much out on Tuesday. A few more Fed speakers on Wednesday. Not much Thursday and Friday for an overall quiet week. We'll just get a few Fed speakers in which they pretty much all just toe the line that Jay does. And surprisingly, the fear and greed index still in the fear zone, just looking underneath the hood. We've got momentum and greed, stock price strength, still extreme fear. And that's breadth, which still has a bit more work to do. We can see that in the McClellan summation index, and the difference between stock and bond returns is saying that we're still in a fearful environment as well. Corporate insiders coming back after the blackout period. That's likely to help the stock market going forward as well, as most companies, we're in a company stock buyback blackout period, and that with looser financial conditions is likely to help this market going forward. In addition to really good mega cap tech earnings, big buyback from Apple. Doesn't really matter that their business is shrinking. They can squeeze the stock price higher anyway. But there's the work needed for Brett. Still only got 42% of stocks above their 50-day average, and not really breaking out on net new highs either. But like I said, volatility risk premium is rock bottom there. Option dealers are not forecasting any volatility in this market for some time now. And the sharp pullback in short-dated bond yields, exactly what the Fed and Treasury wanted, which like I said, may have put a floor underneath the bond market here and helping to get the dollar to pull back as well. Gold just consolidating, crude definitely helping the picture, and the market slightly pulling back on its inflation expectations. Likely on the back of that move lower in crude, semis starting to bounce back along with home builders, energy still having a pullback. However, the defensive and stagflation trade of utilities actually found higher highs and higher lows today. The cannabis trade just consolidating above the 50. And like I said, animal spirits coming back. We can see that in the meme space. Look at all this green in my watch list here. Got Beyond Meat up 13%. Huge move in GameStop. The bulls are coming back. And so there we have it, guys, to finish this week out. Looks like we're jamming up. We've popped out. I'd expect this resistance zone to be taken out. And who knows, we could be testing all-time highs within a week or two. The conditions are there for it now, with the Fed and Treasury loosening conditions, providing more liquidity to this market. Pretty good earnings, bond yields materially moving back, crude dropping, volatility dropping. We just need a little bit more work on Brett, but we've got the Nasdaq and the Russell back above the 50-day VWAPs. Can see my wave flow indicator here starting to go green again, along with the market color is looking pretty bullish here. So I'd expect some higher highs going into next week, and we don't really have much out on the economic calendar to move things as well. So thanks very much for tuning in to the Click Capital Daily Market Review and supporting my efforts. And like I said, you can always watch this show first on X, Twitter, by following me on there and clicking the notification icon. You'll get a push notification on your phone as soon as I've published my latest video. Have a great weekend and come back to the Click Capital channel for my weekend special videos as well. Cheers.